Hello, good morning and welcome to ET. Now's the newspaper show with me, Varun Hiremat. For the next half an hour, we'll be walking you through the important headlines from the Economic Times as well as the Times of India. But before we do that, or I say anything further, let me remind you that the newspapers are completely safe. It's time to get your newspaper delivered to your residence once again if you aren't already. So please go to wantmypaper.com where you can explore all the delivery options for the newspaper to your residence. I repeat, wantmypaper.com if you are interested in the newspaper. With that being said, let's now get a move on. It's safe to do so. And the top 10 headlines from the Economic Times are looking really interesting this morning. Let's begin with the fact that Rowe is set to hike its stake in UTI Trustee Co. to 51%. Next in line, the Great Wall Motors awaits nod to enter India. Reliance Retail buys a 60% stake in Netmeds parent. 5 million salaried employees lost their jobs in July, says the CMIE. SBI set to raise up to 10,000 crore via a Tier 2 bond issue. China's central bank buys small stake in ICICI. Airtel set to replace Huawei and ZTE for 5G trials. Considering MSME status for dealers, says Nitin Gadkari. Theatres may open next with checks and curbs. And finally, Dream 11 takes guard as IPL title sponsor. Okay, so those were the headlines. Let's now bifurcate for you market versus corporate, beginning with the market headlines. And the top 5 out of here are that the top 10 banks have write-offs of 19,000 crore NPAs in Q1. The Reserve Bank plans rival for NPCI. Max Health readies for a debut this week. Bandhan plans insurance foray. And Multiplex stocks good recovery bets, says HSBC. Let's now also get you a feel for what's happening in the corporate world. And Indiabulls Realty and Embassy have inked their merger pact. Ad spends may grow by 60 to 70% in the second half. Retailers managed to make a big dent on rent. Flipkart business tops pre-COVID levels, says the Walmart CEO. And Imami can't use Glow and Handsome for now. Okay, let's go to page 10 of the Economic Times. Whenever Reliance comes up, we're used to hearing billion-dollar deals. People are putting thousands of crores into Reliance, or Reliance is looking to buy out Future Retail, which is again a multi-thousand crore franchise. Today, the values are a little smaller. They've bought a 620 crore stake in a very interesting company, but I won't tell you anymore. Ajay is now with us, and he's got a firm grip on this. 60% stake has been bought in this Chennai-based company. So, good morning, Ajay. Welcome to the show. Great to get perspective from you, as always. What does this deal mean for Reliance?
Good morning, Varun. In fact, this is a small Chennai-based wholesaler of pharma, which actually progressed into, internet and app-based delivery of medicine on demand. So this may appear small at 620 crore, but it is actually filling in a jigsaw for Reliance Retail, which is wanting to replicate the Amazon model here in India with the 400 million users of their of the Jio phone. They would be they are being aimed first as far as Reliance Retail business is concerned. So apart from the brick and mortar retail model, they are wanting to have a very exhaustive internet app-based model for retailing as well, which will have all these categories of grocery, of medicine, even internet-based education, etc. So we've seen other earlier similar buyouts as well of Grab and all of those food delivery, etc. This time they are filling up their gap of medicine delivery. And remember, in these times, globally, medicine as a percentage of their wallet share is becoming a big expense. So every household has some percentage of their overall spend into medicine. It could be over the counter, it could be critical medicine, whatever it is, but it's gaining share of the wallet. So they thought of why not filling in this end of their overall requirement as well. Netmed was doing well. There are a bunch of young entrepreneurs, so they become Reliance employees now, and Reliance will, remember, scale it up to proportion which perhaps Netmeds management would have taken time for. So it's like they are actually making a nice bouquet of startups and filling in with their various requirements.
No, thanks for that, Ajay. You said the magic word, scale, right? And that's what this company does. Doesn't matter what size you are when they buy you, they'll ultimately find a way to take it to the scale that it needs to be in order to compete with the largest players. We've just seen them do that with telecom. We're seeing them do that with retail. So it seems that something might be on the anvil as far as pharmacy goes as well. But thanks, Ajay, for bringing us that important story. Always great to get perspective. Let's now switch gears. Page 1 of the Economic Times, and quite a headline this morning. U.S. asset manager T. Rowe Price is set to increase its stake in UTI trustee company to 51% from the currently 26%. So Jayesh Khilnani is with us. Good morning, Jayesh. What's the significance of this deal? What does it really mean for the country's 8th largest mutual fund?
Good morning, Varun. So rightly mentioned that the U.S. asset manager is actually increasing its stake in UTI trustee company to about 51% from 26%. Now, they are already the biggest shareholder in UTI mutual fund, and they will acquire the portion of the shareholding from 4 different domestic investors, namely LIC, SBI, Bank of Baroda, as well as PNB. So these are the 4 domestic companies that they will actually take the stake from. Now, what this means for the mutual fund and the acquisition is that sources are telling us that a higher holding in the trustee company will allow the U.S. asset manager the right to appoint directors on the board of the trustee company, and thereby get indirect access and bigger say in the operations of the mutual fund. Now, the domestic shareholders will exit, of course, the board of UTI trustee as well once the transaction is completed. Just to give you a background of how the shareholding stacks up currently, SBI, LIC, PNB and Bank of Baroda are the 4 shareholders which own about 18.5% each in UTI trustee. Now, these firms, will also own about 18.24% each in the mutual fund company as well. So the decision to sell a little more than 8% stake in each of these trustee companies to the U.S. asset manager actually follows from the pressure that SEBI has been applying to cut their holdings in both the firms. Because remember that these domestic institutions also have more than 10% stake in some of the other mutual funds in India as well. They have their own arms as well. So, to eliminate the cross-holding conflict of interest shareholding pattern, the regulator has been asking them to reduce their stake in UTI asset management as well. And hence, this move could be beneficial for UTI AMC because they will have new management and they will have, other guidelines that the U.S. asset manager would actually implement. And, maybe it could become from 8th largest to, it will gain market share and then scale to higher levels as well.
Right, Jayesh. Thanks for that. So there seems to be, according to Jayesh, 2 elements here. One is obviously compliance, but the second is also strategy, and there will be some strategic synergies that could arise from the entry of T. Rowe Price, or rather from them hiking their stake. So thanks for that, Jayesh. An important headline, and we'll be tracking it pretty closely here at ET Now. Let's now move on to the auto sector. And again, page 1 of the Economic Times, quite an important headline story this morning. Great Wall Motors. Now, in case you can't guess which country this company comes from by hearing the word Great Wall, it's obviously a Chinese company. It recently was known for acquiring GM's certain businesses. That's General Motors, right? So they acquire General Motors Talegaon factory, which is here in India, for 950 crore. Now, this was the first tranche in a $1 billion investment plan that Great Wall had in terms of entering China. Now, let's remember, since that transaction got completed, FDI, particularly from China, has become a bit of a tricky issue. Geopolitical tensions between them and the US and between them and India are pretty loud and evident right now. There's currently an ban app, Chinese ban on these 40 apps, which is currently going on. So it'll be interesting to see how their future entry into the SUV segment of India pans out. But for now, it seems that it's perhaps taking a bit of a hold, and they're waiting for India to approve their most recent investment directive. So it'll be interesting to see if this company is let in and exactly what the prospects for it lie ahead in India. But from auto, we're now going to switch gears to e-commerce a little bit, and it's perhaps you can take this as your good news of the day. Page 3 of the Economic Times, GMV, gross merchandise value that is, at e-tailer Flipkart has exceeded pre-COVID levels since it resumed operations 3 months ago. And this statement has come from the US parent of Flipkart, that's Walmart, in their recent earnings call. And let's remember, Walmart is the world's largest retailer. So again, we've crossed pre-COVID levels. Walmart has posted a 6.8% drop in sales due to lockdown. So it's encouraging that on the e-commerce and e-tailing side, you're definitely not seeing any pullback whatsoever. Seems to be quite well. One final quote I can just give you from the CEO, Doug McMillon, is it was nice to see once government restrictions started to get lifted, how the volume came back. We are staying close to decisions that they are making and excited about strategy going forward. So Walmart parent seems quite upbeat on Flipkart, and good to see that the e-commerce volumes are really holding up. Let's now move forward to our next story, and this is on page 2 of the Economic Times. And India, Japan and Australia have begun discussions on launching a trilateral supply chain resilience initiative. Vinny is here to walk us through what this means and what exactly this agreement entails. Over to you, Vinny.
Good morning, Varun. So, as we already know how, aggressive the China's political as well as military behavior has been. Looking at that, Japan was the first to propose that we take this supply chain into consideration where, India, Japan and Australia, they work together to form a supply chain which will help all these three countries as well. Now, Japan, through its Ministry of Economy, Trade and Industry, had approached India and, pressed on the urgency of the situation and initiative, to take this supply chain resilience initiative very soon. They wanted to start by November, and maybe we'll see a meeting which is held by all the trade and commerce ministers of the countries next week. So surely we're going to keep a close eye on that, what actually pans out. Also, the Japanese minister Abe, following this outbreak, they had already instituted a $2 billion fund to help the Japanese companies shift back from China. Even Australia and US, amid these growing situations and transparency concerns, have already entered into an ambitious agreement to create what's being called the China free supply chain. So this is what this is where everyone is a bit concerned about the current situation going on with China, and that's why countries are getting together to maybe become China free. And in India, as we call it as, Atmanirbhar, or focusing on becoming less dependent on China. So, we'll keep a close eye on how this actually pans out and what is the supply chain agreement they actually form.
Right, Vinny. Thanks for that. Super interesting. Everyone's going against China right now. US, here in India, Japan, Australia, like Vinny just mentioned, we're forming a trilateral perhaps agreement to reduce our dependence on China. So that seems to be the theme these days, along with an Atmanirbhar Bharat. But thank you, Vinny, for bringing us that this morning. Great to get perspective from you. Let's now move on. Page 6 of the Economic Times. Nearly 5 million salaried employees lost their jobs in July, taking the total number to 18.9 million due to the COVID-19 pandemic. So that's quite a contradictory point, which we don't really focus on too much, that the employment numbers are still looking quite dismal and people are still losing their jobs as late as July, even when the so-called unlock movement is said to be taking off. That marks a reversal from a brief recovery in salaried jobs in June and likely reflects a slump due to the imposition of mini shutdowns in containment zones. So, as various pockets of the country are facing their own issues with reopening, surely employment figures are going to reflect that hardship. Okay, yesterday we had a really important case that was to be heard, the AGR dues case, and I know it sounds like a never-ending saga now. It's been on for the better part of a year. But on Tuesday, the latest development from the saga is that Reliance Jio told the Supreme Court it was willing to pay the AGR dues to the extent it had used RCOM spectrum apart from the spectrum usage charges levied for such use, estimated at 30% of the RCOM spectrum. So Jio has refused to pay the AGR dues of RCOM, which had used the rest of the 70% spectrum. Let's cut across to Abhimanyu for more on this.
The Supreme Court will continue its daily hearing in the AGR case today. Yesterday, the top court had questioned that how could spectrum dues be considered as operational dues when they form the very basis of operations of telecom companies. It observed that spectrum cannot be treated as a manufacturing input and questioned if RCOM went into liquidation by itself. The court also questioned what was the impact of NCLT proceedings on RCOM's fall in value from around 35,000 crores to around 10,000 crores. Appearing for lenders of Reliance Communications, senior lawyer Harish Salve had submitted that spectrum cannot be treated as an issue of bankruptcy proceedings. He had stated that bankruptcy of RCOM was triggered by the Ericsson dispute and insolvency can be exited only after payment of 90% of the loan amount, which is not possible for Reliance Communications. He also said that resolution plan has already proposed the right to use spectrum and had said that spectrum was diminishing in value, which led to the fall in value of RCOM as of now. He said that tax demand remains subservient to dues of financial creditors as per waterfall mechanism. It remains to be seen what is going to be the observation from the top court's side today. The court verdict on the timeline of AGR dues payment is still awaited, a verdict which is eagerly awaited by the banking and the telecom sector.
Okay, thanks for that, Abhimanyu. We're now joined by Poonam. Good morning, Poonam. Welcome to the show. SBI is doing a 10,000 crore bond raise. Could you explain to our viewers how this is different to an equity raise and how perhaps it's reassuring that SBI hasn't diluted equity to raise money at this time and is finding sufficient funds available in alternative markets?
Well, good morning, Varun. In fact, yes, SBI does have plans to raise nearly around 10,000 crore through issue of Tier 2 bonds, and this would be the first said by State Bank of India in terms of the Tier 2 bonds. It is likely to attract domestic institutions or investors like LIC and EPFO. Now, just firstly, in terms of the bonds, Tier 2 bonds are expected to offer 6.65 to 6.75% rate with a 15-year maturity. And do note that, Varun, to your question, how different it is from an equity capital, well, these are debt instruments and these help shore up the overall capital base of State Bank of India. SBI, this is very different from an equity capital raise, although SBI also has plans to raise equity capital, but due to the current market conditions, it is probably not feasible at the moment. There is a board approval capital plan for FY21, wherein SBI plans to raise capital via Tier 2 AT1 bonds as well as equity capital. Also, SBI does plan to raise nearly around 20,000 crore worth of equity capital through various means also during the year. They do have sufficient capital as of now. Its capital adequacy stood at 13.06% for FY20. If we look at the rating also, CRISIL has rated SBI bonds at AAA with a stable outlook. So net, yes, this would be a capital raising via debt instrument. And we will have to wait and watch out for when the equity capital would be raised. But as of now, this is not equity dilutive.
Thanks for that, Poonam. Definitely not equity dilutive for SBI right now. But we're running out of time and we're coming to the end of our show, so we're going to have to speed up a little bit. One key positive piece of news I can give you, keeping it from banking, is that the People's Bank of China has made a quiet entry into ICICI Bank as a shareholder. They've have now over 1% stake in the housing finance major HDFC as well. And this just marks entry of Chinese sovereign bank or entity into Indian private banks. So however you'd like to view that. Let's cut across to Vivek also. Indiabulls Real Estate is in focus, and two subsidiaries of Embassy Group, they've now entered into their agreement. The pact has been inked. Good morning, Vivek. Could you walk us through the fine print, please?
Morning, Varun. So, it's a much-awaited merger. Waiting for the contours of the deal, and finally the contours of the deal are out. Indiabulls Real Estate and Embassy Group have finalized the merger and the shares ratios for them to become one joint combined entity. It could be listed on the Indian stock market exchanges. Indiabulls Real Estate will benefit from a new promoter, Mr. Gadkari, with a lot of experience as far as the real estate market in India is concerned. And they would, the Embassy Group would benefit from having increased access. Number one, they would be listed on the stock market exchanges, and increased access to institutional as well as retail shareholding funding is something that they would get access to. So now you're talking about, the existing shares of Indiabulls Real Estate. The existing shares could be valued at close to 92.5 rupees a share. Again, a significant premium to the closing price of yesterday. Embassy Group will now become the new promoters, with close to 45% stake, and the existing promoters led by Samir Gehlot would now, have a minimal stake, close to 10%, and it will be interesting to see what exactly they do with this particular stake. The combined joint entity would be a mega player as far as the residential as well as commercial projects of real estate in India is concerned, and could act as a feeder as far as the embassy REIT in India is concerned.
Okay, Vivek, thanks for that. Very important update and very important story that ET now has also been on top of. Almost time for the market at 8 a.m. But before we do, let's just get you the top 5 from the Times of India. India eyes Oxford vaccine by year end. A record 1,100 deaths in India and 64,000 new cases. Congress writes to Zuckerberg on right-wing bias. Lavasa resigns as EC head of joining ADB. And Axis plans to bank on gig workers. So those are the headlines from the Times of India. Do have a look. We're done here at the newspaper show, so goodbye from me. You have the Impaired segment coming up, but keep it with ET now for the market at 8 a.m.